When you reach the age of 59 and a half, a significant milestone occurs in your financial life. For the first time, you gain penalty-free access to the retirement funds you've been diligently accumulating in your 401k, IRA, or 403b accounts throughout your working years. This moment represents decades of savings, compound growth, and financial discipline finally coming to fruition. However, just because you can access these funds without penalty doesn't necessarily mean you should withdraw them without careful consideration and strategic planning. Consider a common scenario that plays out across America every day. You've reached age 62, and you're contemplating retirement, or perhaps you've recently lost your job. The prospect of starting Social Security benefits becomes appealing, even though you know that claiming at 62 means accepting benefits earlier than your full retirement age. For someone born in 1966, the full retirement age is 67, which means claiming at 62 results in a permanent 30% reduction in monthly benefits. Despite this reduction, many people decide they're comfortable with the trade-off because they have other assets available, particularly the substantial balance sitting in their 401k account. The temptation in this situation can be overwhelming. After years of watching that account balance grow, the idea of taking complete control of those funds becomes increasingly attractive. Perhaps there's $100,000 accumulated, maybe more, maybe less. The reasoning often goes something like this: it's your money, you've earned it, and you don't want to leave it with your former employer. The plan, if you can call it that, might be as simple as transferring everything to a savings account and figuring out the details later. Unfortunately, this approach represents one of the most common and potentially costly mistakes in retirement planning. The fundamental problem with this mindset is that it fails to account for the complex web of tax implications and downstream consequences that accompany large retirement account withdrawals. Before touching a single dollar of your retirement savings, seeking guidance from a qualified professional becomes absolutely essential. This means consulting with an accountant who specializes in retirement taxation, or a certified financial planner who understands the intricate relationships between retirement income, taxes, and government benefits programs. The first reality check comes from understanding who has a claim on your 401k money. The federal government, through the Internal Revenue Service, has been patiently waiting for its share since the day you made your first contribution. Traditional 401k accounts operate on a tax-deferred basis, meaning you didn't pay income taxes when the money went into the account, and you didn't pay taxes as the investments grew over the years. This tax advantage helped your retirement savings compound more effectively, but the IRS always intended to collect its share eventually. That day of reckoning arrives when you take distributions from the account. Some financial educators have pointed out that residents of states without income tax, such as Wyoming, Texas, or Florida, enjoy a particular advantage when withdrawing retirement funds. While these states won't impose state-level income taxes on 401k distributions, the federal government absolutely will. There's no escaping federal taxation on traditional retirement account withdrawals. The IRS will assess taxes based on your marginal tax rate, which means the amount you withdraw gets added to your other income for the year and taxed accordingly. This is where the concept of creating a taxable event becomes critically important. When you withdraw $100,000 from your 401k in a single year, you're not simply accessing your own money. You're creating a $100,000 taxable event that will be added to any other income you receive that year, including Social Security benefits, pension payments, investment income, or earnings from part-time work. The combined total determines your tax bracket and ultimately how much of that withdrawal you actually get to keep. However, the tax implications represent only part of the story. There's another significant consideration that catches many retirees completely off guard: the impact on Medicare premiums. Understanding this connection requires knowledge of how Medicare Part B premiums are calculated and the peculiar timing involved in that calculation. Most people become eligible for Medicare at age 65, assuming they're not receiving disability benefits which would qualify them earlier. If you're 62 and contemplating a large 401k withdrawal, you might initially think Medicare considerations don't apply to you since you're still 3 years away from Medicare eligibility. However, this assumption fails to account for Medicare's unique look-back period when determining premium costs. Medicare uses a system called IRMAA, which stands for Income-Related Monthly Adjustment Amount. This system adjusts your Medicare Part B premiums based on your income level. But here's the crucial detail: Medicare doesn't look at your current income to determine these premiums. Instead, the program examines your modified adjusted gross income from 2 years prior. This 2-year look-back period creates a delayed consequence for large taxable withdrawals that many people fail to anticipate. Let's walk through a specific example to illustrate how this works in practice. Suppose you're 63 years old and decide to withdraw $100,000 from your 401k. You pay the income taxes on this withdrawal, perhaps thinking that's the end of the financial impact. Fast forward 2 years. You're now 65 and enrolling in Medicare for the first time. When Medicare calculates your Part B premiums, they'll examine your income from when you were 63, which includes that large 401k withdrawal. That single withdrawal could push you into a higher IRMAA bracket, significantly increasing what you pay for Medicare Part B coverage. The financial impact can be substantial. Depending on how much the withdrawal increases your income and which IRMAA bracket you fall into, you could face thousands of dollars in additional Medicare premiums. If you're married, the situation becomes even more costly because both you and your spouse could face increased premiums based on your combined income. A poorly timed 6-figure withdrawal could easily result in an additional $6,000 or more in Medicare costs that could have been avoided with better planning. What makes this particularly frustrating for retirees is that the increased premiums typically last for 1 year before reverting to normal levels, assuming your income returns to lower levels in subsequent years. However, if you continue taking large distributions or have other significant income events, you could find yourself paying elevated Medicare premiums year after year throughout retirement. The IRMAA system includes 5 different income brackets, each with progressively higher premium adjustments. These brackets adjust annually for inflation, which means planning around them requires projecting future income thresholds, not just understanding current ones. Many financial professionals, including accountants and even some certified financial planners, aren't well versed in how IRMAA works and how retirement account withdrawals can trigger these increased costs. This knowledge gap makes it even more important to carefully vet any professional you're considering working with to ensure they understand these Medicare implications. It's also crucial to understand that IRMAA doesn't just affect you when you first enroll in Medicare at 65. The 2-year look-back period means that large taxable events at any age during retirement can trigger increased Medicare premiums 2 years later. A significant withdrawal at 67 affects your premiums at 69. A large distribution at 70 impacts your costs at 72. Throughout your retirement years, you need to remain mindful of how current income decisions will affect your Medicare expenses in the future. This discussion doesn't even touch on more advanced strategies like Roth conversions or other techniques for moving money from taxable retirement accounts to tax-free vehicles. These strategies have their own considerations and timing requirements that go beyond the scope of basic withdrawal planning. The fundamental point remains that accessing your retirement funds requires much more thought than simply deciding you want your money. Before making any significant withdrawal from your 401k or IRA, developing a comprehensive plan becomes essential. This plan must account for your specific circumstances, including whether you're married, divorced, considering remarriage, or widowed. Your spouse's income, if applicable, plays a role in the calculations. Your cost of living, your retirement goals, your health status, and your life expectancy all factor into determining the optimal withdrawal strategy. The tax treatment of different retirement accounts also varies significantly. Roth IRA distributions, for instance, come out tax-free since you paid taxes on the contributions when you made them. Traditional IRA and 401k distributions, conversely, face full taxation. Understanding which accounts to tap first and in what amounts represents a critical component of tax-efficient retirement planning. Professional guidance becomes particularly valuable when considering how to structure your withdrawals to minimize both current taxes and future Medicare costs. Rather than taking large lump sum distributions, many retirees benefit from spreading withdrawals across multiple years. This approach keeps annual taxable income lower, potentially maintaining you in a lower tax bracket and avoiding IRMAA surcharges entirely. Similar strategies apply to other major financial events like selling rental properties or taking large capital gains. Spreading these income events over time rather than concentrating them in single years can save substantial money in both taxes and Medicare premiums. The goal isn't to avoid taking your money or to suggest you shouldn't access your hard-earned retirement savings. Rather, the objective is to maximize what you actually get to keep after accounting for federal taxes, state taxes where applicable, and Medicare premium adjustments. Your 401k money is indeed your money, and once you reach 59.5, you can access it penalty-free. However, penalty-free doesn't mean consequence-free or cost-free. Making optimal decisions about retirement account withdrawals requires professional expertise that accounts for the full picture of your financial life. This planning extends well beyond the capabilities of general financial education resources and into the realm of personalized financial planning based on your unique circumstances. While educational information can help you understand the issues at stake and ask informed questions, it cannot replace individualized guidance from qualified professionals who understand both tax law and Medicare regulations. The professionals best equipped to help with these decisions typically include certified financial planners with expertise in retirement income planning, specialized tax accountants familiar with retirement taxation, and sometimes estate planning attorneys who can help coordinate your overall financial picture. The key is ensuring whoever you work with specifically understands IRMAA and how retirement income affects Medicare costs. Many otherwise qualified professionals lack this particular expertise, so asking specific questions about their knowledge of Medicare premium calculations should be part of your vetting process. Taking control of your retirement assets represents an important milestone and an opportunity to shape your financial future. However, this control comes with responsibility to make informed decisions that consider both immediate and long-term consequences. The few hours invested in professional planning before making major withdrawal decisions can easily save thousands or even tens of thousands of dollars in unnecessary taxes and Medicare costs over your retirement years. Your decades of diligent saving deserve equally diligent planning when it comes time to access those funds.